we've got some breaking inflation data to bring your way here this morning as we're tracking CPI, Consumer Price Index, year over year. We're seeing the figure come in at 3.2%. The expectation was for 3.3%. We're taking a look at some of the immediate reaction in the U.S. major averages and the futures here as we're taking a look at some of the specifics within this report. The month-over-month figure was actually flat here, where it was expected to come in at a rise of about 0.1%, Seana, here, and then ex-food and energy month-over-month, that came in at 0.2% year-over-year. That figure for ex-food and energy, 4% right now.
Yeah, certainly. And digging into this report just a little bit and seeing where some of those pricing pressures still remain. The index for shelter continuing to rise in the month of October, that offsetting some of the decline that we did see in the energy and the gasoline index here. So that's why we did see it resulting, obviously, in the unchanged month-over-month figure. Energy index falling 2.5% over the month as a 5% decline in the gasoline index. We're taking a look at how futures are reacting to this print. At least initially, we're seeing some movement here to the upside. But certainly as we dig into this, of course, the question that traders, economists, strategists are all asking is what exactly this means for the Fed and whether or not this changes the calculus at the next meeting.
Yeah, you mentioned shelter and the indexes, which increased all in October. That includes rent, owner's equivalent rent, motor vehicle insurance, medical care, recreational care, or not recreational care, but personal care as well. So it's good to see that people are tapping into the deodorants and antiperspirants out there. But the indexes for lodging away from home, used cars and trucks, communication, and airline fares were among those that actually decreased over the month. So some interesting metrics there, especially given all of the airline news that we've been tracking over the course of this week. We'll dive into that later on during our 9 a.m. hour. But let's get to our executive editor, Brian Sozzi. He's standing by at the Wi-Fi Interactive at the touchscreen. Hey, Brian.
Brad, of course, deodorant always very, very important to one's life. Good to see prices for that coming down. So as you mentioned, futures really ticking up on the CPI report. And if you are trading this market, really, there's one thing you need to watch out for, and I think it really explains why you're seeing this market rally, as you see here, really a strong advance off the CPI report. It is Fed fund futures. Now, coming into the CPI print, there was about a 28% chance that the Fed would actually hike rates at its most recent meeting coming up in December. Now, it's likely that will get dialed back even further, and then by extension, this report, at least initially, looks to give credence to some of the calls we saw out on Monday from Goldman Sachs and Morgan Stanley. Maybe we get that first round of rate cuts by mid-June. That's why the market is rallying initially off a print like this. It is feeding that narrative now on Wall Street that disinflation is alive and well. And just anecdotally, I was talking to Tapestry CEO yesterday at a conference here in New York City. I asked her about the inflationary outlook. She is seeing disinflationary forces in her supply chain, and I can tell you, she is not alone. But again, this report initially feeding that disinflation narrative on the street and supporting, I think, a lot of the bullish case that has enveloped stocks over the past month and a half, Seana.